Hey everyone, welcome back to Corporate Decoder. Today paid Incorporated. Incorporated filed its quarterly report for the 3 months ended the 31st of March 2026, and I'm seeing some interesting moves in their revenue and expenses. Quick note, this is not financial advice, just my take on public filings for educational purposes. Paid Inc. is showing stronger revenue growth, but the story is in how they are managing their costs and where their future money might come from. Scroll Paid Inc. Form 10Q side scroll. Alright, let's dive into the numbers for Paid Incorporated. Incorporated, ticker symbol paid, this is their quarterly report, their 10Q covering the first 3 months of 2026. It gives us a snapshot of how the company is doing right at the start of the year. Scroll condensed consolidated balance sheets. Scroll starting with the balance sheet, which is like a snapshot of what the company owns and owes. At the end of March 2026, Paid Incorporated. Incorporated had about $951,000 in cash and cash equivalents. That is down a bit from over $1.1 million at the end of 2025. Scroll accounts receivable. Net to Scroll their accounts receivable. Money owed to them by customers went up from about $302,000 to $441,000. This usually means they've made more sales on credit, which is good, but also means they're waiting to collect that cash. Scroll intangible assets net to Scroll. Now, a big number here is intangible assets, which are things like patents, software, and customer lists that have value, but you can't touch. It's at $1.88 million. This has grown from $1.75 million at the end of last year, likely due to their recent acquisition. Scroll total assets Scroll overall. Their total assets grew to about $8.39 million, up from $8.27 million. So the company is growing its asset base, which is a positive sign. Scroll accounts payable Scroll on the liabilities side. Accounts payable, what they owe to their suppliers, is pretty stable at around $1.39 million. Scroll notes payable Thuddy Scroll, interestingly. They now have a $75,000 note payable, which wasn't there at the end of 2025. This is likely related to their recent acquisition, we'll get to that. Scroll total liabilities. Scroll total liabilities are around $2.74 million, a slight increase from the end of 2025. Scroll total shareholders' equity for Scroll and shareholders' equity, which is essentially the company's net worth, is up to $5.64 million from $5.54 million. This growth in equity is driven by how the company values its stock and its overall financial performance. Scroll condensed consolidated statements of operations and comprehensive loss. Scroll. Now let's look at how the company performed financially in the first quarter of 2026 in the statement of operations. Scroll revenues. Net Scroll revenues, which is the money they brought in from sales, jumped to $5.32 million. That is a solid 22% increase from $4.37 million in the same period last year. That is a good sign. They are selling more. Scroll cost of revenues Scroll. But the cost of making those sales, the cost of revenues, also went up significantly, from $3.35 million to $4.26 million. This means that while they are selling more, the cost to deliver those products or services also increased. Scroll gross profit Scroll. This led to a gross profit of about $1.06 million, a small increase from $1.02 million in the prior year. However, their gross profit margin, which shows how much profit they make after accounting for the direct costs of their sales, actually decreased slightly to 20%, down from 22%. This indicates that their costs are growing a bit faster than their revenues, which is something to watch. Scroll share-based compensation. Scroll one significant change is in share-based compensation. It jumped from just $1,267 in the first quarter of 2025 to a substantial $61,251 in 2026. This means they are giving out more stock or options to employees, which is a common way for companies, especially smaller ones, to attract and retain talent. Scroll total operating expenses. Scroll overall operating expenses stayed pretty flat, just a tiny decrease from about $1.179 million to $1.178 million. So while revenue is up, total operating expenses are pretty much the same. Scroll loss from operations Scroll because of these factors. The company had an operating loss of about $117,000 in the first quarter of 2026. This is a slight improvement from an operating loss of $159,000 in the same period last year, so they are losing less money from their core business operations. Scroll other income recorded other income of $65,664 in 2026, compared to none in 2025. The report mentions this was due to write-offs of aged payables and accrued expenses. This is not really a sign of strong core business performance, but more of a one-time item that can happen. Pull loss before income tax provision, swimpull. This resulted in a net loss of $41,531 for the first quarter of 2026. This is a much smaller loss than the $148,773 loss they had in the same period last year. Scroll net loss per S-Hair basic, scroll, and on a per share basis. The loss narrowed to 0 cents compared to a 2-cent loss per S-Hair a year ago. This indicates the company is moving in the right direction. Reducing its losses. Scroll foreign currency translation adjustments. Scroll there was also other comprehensive loss from foreign currency translation, which is common for companies with international operations. It was about $15,000 in losses for 2026 compared to $47,000 in 2025. So currency fluctuations are working slightly in their favor this period. Scroll condensed consolidated statements of cash flows. Scroll, looking at the cash flow statement, tells us where the money actually moved. Scroll net cash used in operating activities. Scroll for operating activities. The company used $130,865 in cash in the first quarter of 2026. While this is better than the $477,000 used in the same period in 2025, it means they are still burning cash to run their day-to-day operations. This is typical for growing tech companies, but something to keep an eye on. Scroll payment of accrued common stock bonus to Scroll. A big factor here is a payment of about $124,000 for an accrued common stock bonus. This payment was made in 2026, but not in 2025, so it is a cash outflow that affected the operating cash flow this period. Scroll net cash used in investing activities. Says Scroll in investing activities, they spent about $1,900 on purchasing property and equipment. This is a very small amount, suggesting they are not making large capital expenditures right now. Scroll cash flows from financing activities. Simple, and in financing activities there was no significant cash inflow or outflow reported for 2026, meaning they didn't raise or pay back a huge amount of debt or equity. Scroll net change in cash equivalents. Says Scroll overall, their cash decreased by about $148,000 in the first quarter of 2026, bringing their total cash down to $951,000. This decrease in cash is largely due to the net cash used in operating activities. Scroll paid Inc. Condensed consolidated statements of changes in shareholders' equity. Scroll the statement of changes in shareholders' equity shows how the ownership structure shifted. Scroll issuance of common stock for accrued bonus. Scroll in 2026. They issued over 50,000 shares to 2 officers and 3 employees as part of settling an accrued bonus. The value of these shares was about $124,000. This is essentially converting accrued compensation into equity. Scroll share issuance for warehouse acquisition. Scroll, they also issued over 34,000 shares of common stock to the founders of Warehouse Inc. In connection with the acquisition, these shares were valued at about $101,000. This acquisition added to their intangible assets and revenue streams. Scroll share. Based compensation expense for share. Based compensation expense was $61,251 in the first quarter of 2026, a big jump from just over $1,200 in 2025. This reflects the increased use of stock options and restricted stock units to compensate employees, especially executives. Scroll net loss to Scroll, and as we saw, the net loss for the period was $41,531, which reduced their accumulated deficit. Scroll notes to unaudited condensed consolidated financial statements. Scroll now for the important notes that explain all these numbers. Scroll liquidity and management's plans. Scroll, the company acknowledges it has been incurring losses, although they are taking steps to reduce them. They have $951,000 in cash and a working capital deficit of $353,000. They are also burning cash from operations by over $130,000 in the quarter. Management believes they have enough cash to operate for the next 12 months, but they are also looking at ways to cut costs and grow revenue further. They mention the repayment of a note receivable from Embulks could help, but the timing is uncertain. This going concern aspect is critical, as if they can't fund operations, it spells trouble. Companies like Bed Bath & Beyond and Tupperware faced similar liquidity issues and ultimately struggled. This is a classic microcap scenario where future funding is crucial. Scroll geographic concentration. Scroll, a key insight here is their geographic concentration. In the first quarter of 2026 and 2025, about 99% of their revenues came from Canada, with only 1% from the US. This shows a heavy reliance on the Canadian market. Scroll acquisition of Warehouse Inc. Scroll, they completed the acquisition of Warehouse Inc. on the 30th of January 2026. This company helps businesses with warehousing and fulfillment, and Paid Inc. sees it as a way to complement their shipping label services and cross sell other platform offerings. This is a strategic move to expand their service portfolio. The acquisition was valued at about $176,000 plus performance-based payments. This is why we saw an increase in intangible assets and a new note payable. Scroll intangible assets scroll after the Warehouse acquisition. Their intangible assets include technology worth about $230,000 with a useful life of 3 years. They also have other intangibles from past deals, like customer relationships, which are a significant part of their total intangible assets. Scroll Note 2. Notes receivable through Scroll. The company holds 2 notes receivable. One is with Inbox Inc., which at the 31st of March 2026 had a total due amount of $7.78 million. This note has faced defaults and modifications, but the company expects repayment in 2026 when Inbox consummates a financial or merger transaction. This is a significant amount of money tied up in a single receivable. The other note is a $400,000 note with 5 String Solutions LLC, which can be converted into a 55% ownership stake. Interest income from these notes was about $11,700 in the first quarter of 2026. The large Inbox note is a considerable risk if that expected transaction does not materialize. Scroll Note 5. Commitments and contingencies. Scroll there is a mention of a legal dispute with the former president and CEO, Mr. Alan Pratt. This dispute involves claims of severance pay and an unpaid bonus. The trial for the Canadian litigation is set to begin in May 2026. The company has not recorded any reserve for this because the outcome is uncertain. This is a potential financial risk. Scroll Share, based incentive plan Scroll Paid Inc., is actively using share-based compensation. They issued options to board members and employees throughout 2025 and early 2026. The total share-based compensation expense for the first quarter of 2026 was over $61,000, up sharply from the previous year, indicating a greater reliance on equity compensation. Scroll Note 8. Subsequent events through Scroll. Right after the quarter ended on the 1st of April 2026, 2 shareholders exercised stock options, bringing in $24.38 for 2,500 shares. Also, on the 29th of April, they repaid that $75,000 note payable related to the Warehouse acquisition. These are positive steps showing they are managing their short-term obligations. Scroll Item 2. Management's discussion and analysis of financial condition and results of operations. Scroll, the management discussion section reiterates the revenue growth of 22% driven by their shipping coordination and label generation services, along with the new warehousing segment. They've also retired some older services, which explains the drop in client services revenue. Scroll revenues. Scroll, this section breaks down the revenue. Shipping coordination and label generation services saw a 21% increase, reaching over $5.2 million. Warehousing services, being new, contributed $76,000. E-commerce services saw a significant drop of 81%, mainly due to losing a client. Scroll gross profit. Scroll gross profit increased slightly, but the gross margin percentage dropped, which management notes is a 2% decrease. Scroll operating expenses. Scroll total operating expenses were practically unchanged, showing a tight control on spending in that area. Scroll other income expense. Net Scroll. The other income in 2026 came from writing off old debts, which is a one-time event, not a recurring source of income. Scroll net income losses. Scroll, the net loss for the quarter improved significantly to $41,000 from $148,000 in the prior year. This reduced net loss is a key positive indicator. Scroll working capital and liquidity. Scroll. They highlight their cash position and working capital deficit. Management seems confident in their ability to fund operations for the next 12 months, but they also acknowledge the need for potential additional capital. The success of the Inbox note collection and the launch of new products are key to this. Scroll Item 4. Controls and procedures. Scroll, a significant point here is that management has concluded that their disclosure controls and procedures were not effective. They cite material weaknesses in internal control over financial reporting. This is why they are working on implementing better corporate governance and operational processes. This weakness is often seen in companies that are growing rapidly or have gone through acquisitions, but it is something investors should be aware of. Scroll Item 1. Legal proceedings. Scroll, the legal proceedings section elaborates on the dispute with Mr. Pratt. Confirming the trial for Canadian litigation is set for May 2026. Scroll item 2, unregistered sales of equity SA securities and use of proceeds. Scroll. In March 2026, they issued about 50,000 shares of common stock for bonus compensation, relying on exemptions from registration, which is standard practice for such issuances. Overall, Pennsylvania ID Incorporated is showing revenue growth and is shrinking its losses, which is a good trend. The acquisition of Warehouse Inc. seems like a strategic move to expand their service offerings. Their heavy reliance on Canada for revenue, the significant amount tied up in the Embulks note receivable, and the acknowledged weaknesses in internal controls are areas that warrant careful monitoring. The key will be their ability to convert this revenue growth into profitability and manage their cash effectively, especially given the uncertainty around the Embulks note. My biggest concern is their continued cash burn from operations and reliance on future capital or successful debt collection to sustain operations. What I'm actually looking for is consistent profitability and strong cash flow generation across all their segments. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.